the committee considers it unlikely that economic conditions will warrant an increase in the target range for the federal funds rate for at least the next couple of FOMC meetings.
Another day to talk money. Where would we be without the ubiquitous figure of one Janet Yellen still holding court in Washington and leaving everyone shaking in their Gucci loafers? We bring some sense to it all. Welcome back to the Newsmax Director of Financial Newsletters, Jeff Yastine, who is not shaking in his Gucci loafers, by the way, because he does not get scared by Janet Yellen does not scare you, does she, Jeff? I mean,
no, she doesn't, and I don't own Gucci loafers. They're JCPenney loafers.
We can take care of that. Don't worry about it. We'll make sure. We need to get you a little bit of a need to get clothing allowance here. We'll take care of those Gucci loafers for you here. Has the market really reacted much at all to what Janet Yellen has said between yesterday and today?
No, well, it did yesterday, certainly, but not today. I mean, the averages are all up only on a fractional basis, but certainly we saw a nice boost yesterday, and it's really telling the market what she told the market what it wanted to hear, which was they're going to be patient, and she's going to telegraph it far in advance, at least two meetings in advance, and they're going to kind of run this out for as far as they can go, as much as they can get away with before they'll actually pull the trigger on interest rates.
Well, if we're looking for a good sign here, new home sales are near a multi-year high right now, so it looks like the housing market, maybe not as sluggish as it was at one time, coming up nicely.
Yeah, definitely, and that matches some of the other things like the National Association of Home Builders Index, et cetera. So again, it all points to continued strength in the U.S. economy. I thought it was interesting that home sales number was as strong as it was, considering it's the middle of winter and so much of the Northeast and Midwest is iced over, and yet people are out there taking advantage of lower rates and a decent economy.
All right, so here's an oil company in Oklahoma, Chesapeake Energy. They're slashing their spending for 2015 and their count of rigs in use in response to the low crude oil prices. All right, Jeff, is OPEC winning?
I'm not sure that they are. The thing that gets missed often in these reports is that, yes, companies like Chesapeake and others are cutting down on their rigs, but the rigs that they're taking offline are usually either ones that are not on wells that just aren't very productive or are very new ones. They're keeping their most productive wells and pumping them for as much as they can. In the press reports about Chesapeake Energy's announcement, it also indicates, like in the Reuters report, that their oil production from the company will still be up, I think, like 3 or 4% for the year if it matches forecast. So again, they're using fewer rigs, but still able to pump as much or more oil.
All right, let's go ahead and talk about some money that is coming out of consumers' pockets right now if you have an American Express card. Annual rates rising an average of 2.5 percentage points to at least 12.99. I still call that 13%. So it is still getting a little bit more expensive to do business because American Express, they hit you with a decent interest rate, and you got to pay that bill right away. You cannot put that off in monthly payments.
What I thought was interesting is that the other credit card companies haven't. This is sort of almost a surprise in some ways to the people who really follow this stuff, because the other credit card companies haven't done similar efforts. And what it's been said in the press reports is that American Express may have basically mispriced what the kind of interest rates they should have been assessing against these various groups of cardholders. And of course, it doesn't help that they lost out on Costco. That contract ends at I believe at the end of the year or at the end of the month. That deal's going away. You have to wonder if they're looking to make that money up in other categories like raising an interest rate.
All right, 30 seconds. Apple's iTunes software infringed on 3 patents owned by a different licensing firm. They got to cough up $533 million now to another firm.
The broader thing for Apple, it's not that big of a deal. The stock doesn't even react to the news from what I've seen. The bigger thing is the U.S. patent system needs an overhaul, because there are a lot of companies out there that own these little patents and come in for big money to big companies and say, hey, you infringed on what we patented a year, 5 years, 10, 20 years ago. And that's the bigger story that's still to be played out on that.
$533 million, a drop in the bucket for Apple, if you will. Want to learn more about money and finance? Here's the way you do it. Go to Newsmax.com and click on the Finance tab. Go to Newsmax Finance. That's where Jeff and the entire team are. They'll let you know what's happening 24 hours a day, 7 days a week. Keep you up to speed on what's happening on and off Wall Street. Mr. Yastine, we'll get you a pair of Gucci loafers, my friend. Thanks so much.
Thanks, Ed.
All right, take care. We have a little more to discuss with regard to your money, and why it's not always a good thing when we hear economists and the like discuss a strong American dollar. Sounds good, makes you think like everything is wonderful. Well, it is if you've got a lot of money to pay out. That's coming up next on MidPoint.